Hello and welcome to this new video. The reason for me to do this video is honestly because I have reached the 200 subscribers. So I did the Caribbean cruise video earlier and I was not planning to do any other video until some requested. But then I thought this is the another good stock in I won't say the good or bad. This is another options in that list of the cruise, and I know people are also need to know what's big. So I thought, okay, why not just do and provide some kind of opinion and let me know as usual how you like it. So again, thanks for my 200 subscriber this channel. Maybe is a lot, but for me is more than a million, honestly. And if I continue get your blessing and love, I'll reach the 1,000 subscribers soon, and then which is my target for this channel, and hopefully that will day come soon. Okay, thank you again, and let's get started. So this is the Royal Caribbean Cruise Limited, and the ticker name is RCL. Myself, Pramod Kumar, I'm a CFA charter holder, and this is my YouTube channel. And in this, I'll analyze the stock based on the fundamental and what's going on in the market and economy as well. So I don't have any disclaimer. I don't have any stocks here, and this is just for the education purpose. If you're new to the channel, kindly subscribe, and there are so many other videos going on like Caribbean Cruise, Uber, Apple, and Baba, and so on in my channel. And also there is a portfolio of big guys like Warren Buffett, Bill Gates, and Charlie Munger. If you want to see those, please go ahead and look it. So let's get started. So there is a hype because now seems like the market is going to open again, and people are thinking maybe that's a good time to buy this dip, so they can make some money out of it, right? So let's see if it's true or it's hard. So I'll totally focus on fundamental, and as a fact what I read, I'll share my opinion without any buttering on top. Okay, so let's start with the returns, right? So these are the top returns: the return on equity, return on investment capital, and the return on assets. I remove the noise because there is nothing much on the 2020, but later on this video what I'll do, I'll start with the net returns and okay, let me just set the agenda. So net returns, then I'll go to the net incomes and try to see from where the income is coming. I'll go deep into that and then come on the liquidity side, and then I'll go to the 10K and show you some facts which might not be easily visible. And then we'll make our opinion based on that. Okay, so that's it, and I'll go from top, deep and deep. So that's pretty much what I'll like to do. And if I don't find anything interesting, usually I just cut off and stop. Okay, and just what I did for CCL as well, which is the Caribbean cruise. Okay, so far it's not look bad, because I take the 5-year data, annual data from their 10K. So it's 2015 to 2019, and this on the left vertical side is the percentage. So you see the return on equity, right? If you have invested there, it's jumped from 8.15% to 14%, and then it's quite good actually. It's not bad in terms of the cruise market, 15%. And also the return on investment capital is 3.21%. If you invested in that, you'll get almost like 8 to 9% or 10% return, right? Which is quite good. And the return on assets, so asset is also generating the good return, right? So that's what trying to showcase here. It was lower, but then 7 to 8%, whatever the ships in case what they have. One big good factor right now is their market. So their the company right now is below their book value, and that's 12% below their book value. So it's also one of the good important facts. So how it's important? So think from that perspective. If you go there and buy all the company and sell all the debt and its assets, try to sell it, you will make 12% return out of it. Think from that perspective. So which is not very common. I'll show you usually what's their book value, price to book value trade they are going on, but I shared some fact there as well. The revenue growth, you see, it spiked like a J curve. So it's 3%, 2%, 3%, and it's gone to 8% and 15% here, right? So maybe that's one of the factor. When I see their chart on Yahoo Finance, maybe I'll try to show to you. So I have a plot show this is the RCL ticker and this is Yahoo. So let's see their price performance, right? So this is their 5-year. Let me bring it up, right? So this is their 5-year price performance, and you see how it's price rally, right? The price is from here is 33 and it goes up and up, right? It's 135. Right now it's their 5-year, almost 5-year low when the cruise came, right? Even below that you see, but now it's trying to jump again in the expectation that okay, the stock might do good, right? You might not find it, but if I try to do this, let's do just for a fun with CCL, right, which is another Carnival Corp. Okay, let's change this color to green. Okay, you see they pretty much both move similar, right? This is not a comparison. I already did my view on the CCL, but this is just to reflect because they are in the same industry, how you see that, right? How they are moving. And you see because of their revenue growth and the growth in the CCL is pretty stale, and that's if you want to do the comparison, right? I think RCL is much better, but you see how it's growing up. Okay, so I think that's enough of that, but I just want to see from where it started and where it stopped. So it's a big rally, right, in terms of the price drop. And also we see this is one plus point. The price wise, the price appreciates a lot is compared. So that's what I'm trying to showcase here. The second thing is, okay, this is their 10Q, right? I was reading the data. So second thing is also their book value, right, which was low. So you can see here, right? Sorry, no book value, the market value is low right now. So we are getting the deal at cheap. Okay, but now the fact is also if the growth is growing up, are they trying to reserve much cash so they have enough liquidity? How much they need for maintenance, or are they investing in new ships? So these all kind of questions are in my mind right now, and I try to see if it can come it's from their the financial statement or 10Q or 10K, if they can give me the answers, right? So let's continue with our questions. I just want to see, right, what is in my mind. Okay, so next level is these are the margin. So the gross profit margin and the EBITDA margin. Sorry about that. I realized that on here you won't able to see, but this is 2018, and maybe I'll move it here myself. Will make it a little bit smaller. Okay, now it's better, I think. So this is 2018 and this is 2015. Sorry about that, but you see this is a recent year. Okay, let's go to the margin. On the margin side, this is the gross margin. So the gross margin here is pretty consistent, and it actually is going up, right? 38 to 47%. The operating margin is 30%. It's less 8%, and here it's drops, and it drops further. So seems like it's getting worse, because you see here it was only 8%, then it's increase here 14, and it seems like consistent to now it's even to 16 to 17% in 19. So seems like these ships maybe require their more maintenance, or there are more marketing or selling going on here. The next thing is the net profit margin or net margin, which was which is coming as 17 to 19%. Okay. Now this is next is from their cash flow operations. So the company is generating enough cash, looks like, right, as compared to their net income. But don't get too distracted from it, because I want to show it to you. Although the company is generated enough cash, but that's not enough, and that I will, before doing that, I'll show you in their 10K. But let's go deeper into some of these data. Before we got, I thought I'll share this one more slide with you. So this is on the EPS, and this makes me a little bit worried as well. Although all those margins are good, why the earning per share is keep dropping, right? If you see 97, 27, 14, and then 4%, right, change. So it's rallying downwards rather than going to upward, right? 2014 to 2019. Now this little bit make me a little bit worried what's happening here, and I really want to see the inside detail one more level down. Okay, now let's see the more data here. I'm seeing more the spreadsheet. So we have seen the return growth, and we have seen some deviation in the earning as well. So what's the issue going on? I just want to, that even if my revenue jumps from 8 to 15%, and why my earning per share is not able to jump, right? The main problem here is, okay, so when revenue jumps, my cost of goods sales also growth, and that's also pretty much higher, right? I didn't expect that to be. So it's 7 to 11%. The next thing is then the reason for, so which reflect in my return of equity as well, right? Because you notice here it was 15 to 15.5 and dropped to 14.8. And the reason for that is that my tax, they have to pay more tax, 1.7%, which was pretty consistent before 1 or 1.5 or these percent. So there's one problem there, right, which reflect in tax burden. The another problem there you noticed, and I also highlighted there, right, that the net profit margins got bad, and also their operating margin got bad. Okay, so these are the things which totally reflect in their reporting return on equity. But okay, so but it's still not bad, right? It's still within the range. But now next thing is I really want to know where they stands in terms of the coronavirus, right? Where they stand, where the company is right now. Can they survive it? How much cash or how this so for the day-to-day operation, right? So what they have. So to answer those, I need to see their liquidity ratios, right? So when I show you, let me show you the liquidity. So this is a little bit more plot. I'll go from, maybe I'll hide this. Okay, I think because I'm doing 5-year range. So when I see their data here, right? So the data is, the current ratio is the ratio on the current asset divided by current liability. So this is not that conservative, but the quick ratio is a little more conservative, and cash is even further conservative, right? So if you see, to cover their current liabilities, they only have 15, on average 17% of their current assets. And this is not for in 2019 recent, or this is always the case. So seems like they are more hand to the mouth, right? Whatever the revenue is coming, generating from the operating cash flow is quite high. So they are trying to circle it up, right? So that's what it's trying. But now in the case of coronavirus, because they look at here, right? It's only 3% or 0.03 to cover the cash. So cash is garbage. Cash is very low, right? So now I'll want to show you one more number here. Keep in mind, right? This is their debt to capital ratio, 53.30%, right? So this is their net debt over the capital. So this means that much debt they have in the company. Okay, so now let's go to their statement. Okay, so this is some of the fact I want to share with you. So this is from their, maybe I'll show you to what is this before I start. So I just downloaded this, but I'll put a link there as well. So this is more from their this is their 10Q statement. Okay, so let me go to this page directly where they have more, I think the more the meat is. So the result of operation, right? So what they're saying here. So now I see, please listen this. So our decision to suspend, so this the management is saying and declaring it in their 10Q. We suspended, and we know they are mentioned at least 31st July, right? So they are not running. And for China selling, stopped by 30th of July 2020. So right now is only May, but it will stop until 31st of July. But even after that, we don't know, right, what will be going to happen. Now look at here on the liquidity side. So what they are doing right now. So what this happened. So they're saying we are experiencing a significant increase in refund. So they have to refund because usually customer booked the ships early. So they have the money, the cash. So that's why you see the cash is, and then they need to now return. But the main problem is highlighted here, and we borrowed an agreed principal of 2.2 billion in March 23rd of this year. Okay, and additional 150 million on May 4th, right, which pursued to be 364 days senior secured term loan. So this is a senior secured term loan they managed to get, but the things get worse after in April. And let me share to you what is this. So this is a big credit company. Okay, so S&P Global, Moody's, Fitch. These are the company when any issuer like RCL, they want to raise some money, they issue debt, right? That means they need to get some fund, because there is a two way to get fund. One, to dilute the shares, right? Go to the public and say, okay, the big investment bank, and they will help to raise the funds for them, which is diluting their shares, right? Other is to just go to this the big and get the debt, right? Okay, so initially they were investment grade upright from BBB. Now they move to lower to BB, right? And on the Moody side is BA3 to BA2. Let me show it to you. What is it? Okay, so look at here, right? So this is I got from Wikipedia. I think this is very nicely summarized there. So this one shows this is a high grade investment grade, right? High, medium. So this all section is investment grade, and this is more like a low or junk bonds. So this is the line there, right? So before they were here, BA3, right? But now they move to the lower, right? So that's what is happening. So even, right? So what does it tell us? If something is moved from investment grade to lower, this means they have to pay more in terms of the interest cost. And as a shareholders, we know there are few categories after which we get the dividend. If this is a dividend, or ultimately it affects the price, right? Because this is a dividend paying share. First, the senior secured lender who is here, they get the money. Then the junior one. But or in summary, once the debt holder get the money, after that, the equity, whatever is left there, the equity shareholder get it, right? But if the debt holder interest is higher, so this means they are claiming more out of the operations of the money. They get more chunk of it. If they get more, it will convert less, come less to the equity shareholder, and which ultimately reflect in their price, and the price will drop. Okay, so keep that in mind. Okay, now let's continue our journey. Okay, so this is very bad news. Next is they're saying our ability to raise additional financing, whether secured or not secured, could be limited if credit is. So now they're saying it's a possibility that their credit can be further downgraded. If it's downgraded when they unable to comply with the rules, because now they're in a bad situation. Whoever gives the money, they want to ensure the company can able to give me the money back. So they put the covenants, right? So these are called the negative covenants. That and in this case, what's the negative covenant? I'll share that to you. Okay, so that's the bottom page is coming. But one thing I want to also say, so this business is very volatile. I think maybe I'll show you that if it's here, right? So that was 1.25. One more thing before I'll come there. This business is also impacted by the UK earlier, right? So 31st March, January, right, 2000, because they have a significant operations in UK. So when the Brexit happened and there was uncertainty, this business get affected. So this business is affected by a lot from the economic side. So that's one thing. And second thing is travels, airlines. And right now, so this means what they are saying, if airline prices are higher, right? You see here, okay, let me read it first. The price increase from the commercial airline service for our guests or major reduction in the airline availability could impact the demand for cruise and underdetermine the ability to reasonable price vacation in our guests, right? So because if the price of the airline is higher or the airlines are not running, who will come to the cruise, right? For sure, as we are their customers, we have a very limited money, right, on the vacation. So we have to calculate each. So if that airline is, and we know right now airline is also in a bad shape, they are not running, they are seeking the bailout, right, from the government. But if they are not running, for sure this is getting impact. So this means not only this, we need to also keep the eye on the airlines, plus need to keep an eye on the economic, right? So if there any uncertainty between where these ships are going, so this very too much risk factors involves here, honestly speaking. Okay, now look at into this one, right? So this one, they're saying right now they have, in how many ships they have? They have 67 ships. Okay, so this is one of the interesting problem. So I think maybe they are also maybe crying, or I'm not sure what will happen. So this is too bad. Sorry, I shouldn't say that. So this is 67 new ships. What a total of 67 new ships with the approximate this berth are a total of 69 ships are on delivery through 2024, including 15 ships are currently scheduled. So this means total 15 ships are scheduled to delivery through 24. So if something is scheduled to delivery, maybe they have paid something and they need to pay for that, right? That's pretty normal, and they are paying that. I'll show you in there the cash flow statement. So now not only they have to survive, but they have to pay for these new ships as well. And which is a double sword game as well, because they cannot just reject as well, because if they reject and the economics goes good, then they are in problem. And if the economics goes even worse, you never know when because the way it can easily be that a second wave of coronavirus, because the opening again, or maybe the government limit. Even if the government open, right, maybe people are little bit afraid, for sure. Like if you ask me, I'm afraid then to go in this mass in those cruises and then get affected. You never know, right, what will happen. So it will take, I think, fair amount of 2-3 years for these companies to come back. Now, given that, let me show it to you. Okay, so maybe I'll show you that first. So let's go to this first, to the cash flow statement. Okay. So here we can see that the purchase of property and equipment, you see, even 2019 they pay almost $1.2 billion. It's a huge amount of money they still need to pay, right, which is reflected in their cash flow statement, and because these are in thousands. And it's not stopped here. They raised a lot of money in debt. You see, debt proceeds. right? And they have to pay a lot of in terms of interest and then dividend paid and going on. Okay, so now, so this is a lot of cash coming. Now let's go to 58, I think. Okay, let me go quickly. Okay, we have covered this, so I'll show you quickly one more. Yeah, this one which we have started from the covenant perspective. Now I'll come to that point. So they're in pretty bad shape right now. So they have a restriction, right? So the fixed covered ratio, basically the coverage ratio, the interest coverage ratio, they need to keep it 1.25 times, and their debt to capital ratio should not be more than 62.5 times. So what does it mean? Okay, so this means the debt holder is saying, we don't want you to go back now and raise a lot of money for debt. Now if this wave comes back 62.5, let me show it to you. Okay, let me show it to you, this number, right? This is just the approximate, this is the number I calculate. So this is their net debt, right? 53.3%. Okay, so this means if they go and they cannot break it a lot, okay, because let's say if they want to raise more debt the way they are doing, and if I'll say, okay, let's do 33, right? You see the number jump. So it's very hard for them to raise more debt. Okay, so they cannot do, so they maybe do little bit on that, but then the worst option is they need to dilute the liquidity. They need to sell more shares and then bring the more money to survive. Now, given this fact, honestly, if I go back here, okay, honestly, for sure this is a good price movement, right? Right now this is 40 and this is 125, but we have to be careful as an investor, as a long-term investor, because how the world will behave. Will the people will go immediately until if they won't go until next year, because Disney park, I'm not sure when it will open, right? So will go, there is no correlation here with the Disney, but these things, the vacation packages goes, but at least for this year I don't think so people will start going that immediately. Even if it goes, they need a lot of money because they are buying new ships. If second waves comes, then it's a very big hit. I'm not sure, maybe the share price can crash and this industry may be worse. So is a gamble. So I think is a bad if somebody will go and do it, because we don't know future. We are not here astrologer or something. Nobody knows the future, right? What's happening here. Okay, so bottom line is, the fundamental looks good, but now the company is in very bad shape, because this is asset heavy business, and to keep those asset heavy business and to come up with that much cash, it needs the revenue going in flow, and which is very hard to do. So I won't go and buy this, but I leave up to you. Whatever you want to do, maybe if you have a lot of cash to burn, or you can want to speculate a little bit, put money, that's up to you. But I don't know, I don't want to take any chances for now, because there are a lot of other opportunities available in the market, which is more global, which is more safe and more reputed. That's what my thought on it. So this is a good business, but it's more risky as compared to the return. So we need to balance both, right, in terms of risk return. That's what my philosophy is. Says. So if you like this video, kindly subscribe and like it. Put the comments if you want me to cover any other stocks, and share this with others. Thank you very much, and see you on the next video.